Managerial Accounting Pricing Lecturer Salah Shmir. Now we will discuss learning objective number 4, determine transfer price using the negotiated cost-based and market-based approach. The pricing technique learning number 1 and 2 and 3 for outside selling, for external selling. Now, how to price internally selling. Transfer prices, vertically integrated companies for parent and subsidiaries grow in either direction of its suppliers or its customers. Merger and acquisition or parent and subsidiaries, there are lots of transfer prices. Frequently transfer goods to other divisions as well as outside customers. Now, if the company wants to price to other divisions or to outside customers, transfer prices. Here's the point: component division. How do you price goods sold within the company? Transfer prices. To answer this question, how do you price goods sold within the company? As you see here, we have two divisions: component division, assembly division. When company divisions sell products to assembly division, how to price these products? Component divisions can sell the product for outside, sell to outside. Here we use pricing, retail price, or may transfer to another division these products, so we use here transfer prices. Retail price for outside, transfer price for internally, and then maybe sell it to outside the second department. Transfer prices. How do you price goods sold within the company? Transfer price, a price used to record the transfer between two divisions of a company. Here we can know maybe downstream sales or upstream sales or horizontal sales. In this situation we use transfer prices. Again, transfer prices for upstream sales, downstream sales, horizontal sales. The price used to record the transfer between two divisions of a company. Ways to determine transfer price: negotiated transfer prices. Second, cost-based transfer prices. Third, market-based transfer prices. Conceptually, a negotiated transfer price is best. The best is negotiated transfer price. Due to practical consideration, companies often use the other two methods. Negotiated transfer prices. Elbart company makes rubber soles for work and hiking boats. two divisions, sole division sells soles externally. Both divisions makes leather bars for hicking boats which are attached to purchased soles. In this company, there are two divisions, sole division, both divisions. Division managers compensated on division profitability. Here's the point. Division managers are compensated on division profitability. So each manager wants to maximize his profit to improve his compensation. Management now wants sole division to provide at least some source to the both divisions. Now the company wants the sole division to make transfer prices or in a upstream sales, horizontal sale. Now the company wants sole division to make horizontal sales to both divisions. How to price these products? Internally, we use the first method, negotiated transfer prices. Computation of contribution margin per unit for each division when both division purchase source from an outside supplier. Now, division A, sole division, in current situation, for making an internally sales, here's the result. Selling price per unit 18, variable cost per unit 11, contribution margin per unit $7. On the other hand, both division current situation, selling price for both 90, variable cost of both not including sole 35, cost of sole purchased from outside supplier 17, contribution margin per unit $38. At the company level, total contribution margin per unit $45, 38 plus $7. As we notice, here's the point. The sole division can sell the products sold. The sole division can sell its product sold at $18. In the same time, the both division can purchase the same product or similar product, so the sold $17. Here is difference between 17 and 18. There are $1. What would be a fair transfer price if the sole division sold 10,000 soles to the both divisions?
قبل بشوف الجبل الجزري كلام ما تكملش عليه ابدا مجال
نحن مستوى وجد أول
Two divisions, sole division, both division. Sole division can sell outside the sold at $18. Realize contribution margin $7. On the other hand, both division can purchase the sold from outside only at $17. Here's the question. What would be a fair transfer price if sold division sold $10,000 sold 10,000 souls to both divisions? What would be a fair price? 18 or 17 or any other price? A negotiated transfer price in the case Nox's capacity at Sol division. If Sol sells to both, payment must the payment must at least cover variable cost per unit plus loss contribution margin per Sol opportunity cost. Here's the answer. The quotation to answer how much the price transfer price. If sold sells to both, in the case no excess capacity. If sold operates in full capacity, it means there is no excess capacity. In this situation, the price will continue two bars. Payment must at least cover variable cost per unit plus loss contribution margin per sold, which is opportunity cost. In this case, the minimum transfer price acceptable to sold will be variable cost $11 plus operating cost $7, minimum transfer price $18. Again, we assume no excess capacity at sold division. So the minimum transfer price $18. Negotiated transfer price, the most bought division, the buyer will pay is what the sold would cost from an outside seller. The buyer division, both division can pay only the price 17, which is the cost when he buys the salt from outside supplier. Because no excess capacity, here the salt division in negotiate this case, I must receive at least my variable cost of $11 plus my opportunity cost $7 or $18 per unit. On the other hand, the buyer division, both division, I will pay no more than $17 cost from outside supplier. So, no deal. Cancel the transfer price or to sell internally. But if sold division has excess capacity, as we see here, can sold division produce 80,000 souls but can sell only 70,000 units outside. So available capacity of 10,000 sold, 10,000 souls, this capacity we can use to produce the internal sales, 10,000 souls. Contribution margin of $7 per unit is not lost. In this case, sold division doesn't lose the contribution margin $7 to these 10,000 units. Minimum transfer price acceptable to sold now in case of excess capacity. Variable cost, that opportunity cost equal minimum transfer price. Variable cost the same $11, but now the opportunity cost is zero because sold division has excess capacity. Minimum transfer price $11. Negotiating the transfer price. Now the sold division, I must cover my variable cost of $11. My opportunity cost is zero. Opportunity cost zero because excess capacity, sold has excess capacity. Both division I will pay no more than $17 cost from outside supplier. Let us make a deal. Reach agreement between sold division manager and both division. Let us make a deal. In this case, the both division and sold division should negotiate a transfer price within the range of $11 to $17. Deal the transfer price between $11 and up to $17. Minimum $11, maximum $17. Negotiated transfer prices, variable cost. In the minimum transfer price formula, variable cost is the variable cost of units sold internally. Variable cost, the variable cost of units sold internally. The variable cost may differ higher or lower for units sold internally versus those sold externally. As we see in the previous example, the variable cost for sold division $11 when he sell the products outside, but when he sell the products internally, the $11 may differ higher or lower. Higher if the both division required higher quality, or lower if we can avoid some of the variable costs as packaging costs, as commission, sales commission, and so on. So when determine variable cost in transfer prices, the variable cost of units sold internally, as we calculate this variable cost in new figures, or maybe remains the same. Again, variable cost is in the minimum transfer price formula. Variable cost is the variable cost of units sold internally. Maybe the same, maybe higher, maybe or lower. The minimum transfer pricing formula can still be used. Just use the internal variable cost. Internal variable cost, the new internal variable cost. Negotiated transfer prices summary. Transfer prices established minimum by selling division and maximum by the purchasing division. Minimum للselling وماكسيمم للpurchasing. Often not used because market price information sometimes not easy obtainable. Lack of trust between the two divisions. Different pricing strategies between divisions. The second method for transfer prices, cost-based transfer prices, uses cost incurred by division producing the goods as its foundation, may be based on variable cost alone or on variable cost plus fixed cost. This method we can use variable cost for transfer prices, or we can use variable cost plus fixed cost. Also, selling division may also add markup to the cost to determine the transfer price. Can result in improper transfer price, causing loss of profitability for company, unfair evaluation of division performance. This method, cost-based transfer prices, can result in improper transfer prices because loss of profitability for the company. Second, unfair evaluation of division performance. If the evaluation of division according to profitability may be meet unfair evaluation. Cost-based transfer prices. Part company requires the division to use transfer price based on variable cost of the sold. Here's the method. The transfer price based on only variable cost with no excess capacity. Contribution margin per unit for the two division are with no excess capacity. In this situation, if the transfer price only the variable cost-based transfer price 10,000 unit, sold division selling a price of sold $11, it's the transfer price. If the company assume required from division to price transfer price according to variable cost, he will be the selling price $11, variable cost 11, contribution margin 0. The both division selling price the same as in the previous situation. variable cost the same, 35, and cost of sold purchased from sold division, $11, contribution margin per unit, $44. Total contribution margin per unit, $44. In the previous situation, the total contribution margin per unit was $45. So the company at whole, at worst situation, the contribution margin is decreased $1. Cost-based transfer prices. Cost-based pricing is bad deal for sold division. We discuss the result here. Cost-based pricing is bad deal for sold division because no profit on transfer of 10,000 sold to both division and losses profit of $70,000 on external sales. As we see, Sol has no excess capacity. Sol no excess capacity. So when he makes internal sales at the price transfer price 11, he lost the operating cost, which was $7 per unit. Cost-based pricing is bad deal for division, for sold division. Bad deal for sold division. No profit in transfer of 10,000 sold to both division and losses. A profit of 70,000 on external sales. 10,000 unit times opportunity cost 7 per unit equals $70,000. On the other hand, both division is very happy, increases contribution margin by $6 per sold or 60,000. As you see, sold division in bad deal, or both division very happy. Sold division lost 70,000 in profit and contribution margin. Both division increase contribution margin by $60,000. Sold division has excess capacity. Now, another situation. If sold division has excess capacity, the division reports a zero profit on these 10,000 units, and the both divisions gains $6 per unit. If their excess capacity, division sold will report zero profit, but both division will increase the gains or contribution margin by $6 per unit. It equals $60,000. Cost-based transfer prices. Overall, the company is worse off by $10,000. From the previous discussion, the company now is worse off by $10,000. Total net income decreased $10,000 because when the two divisions deals separately and deals sell outside, so the soul or buy the soul from outside, the contribution margin per unit was $45. But when they deal with each other, the contribution margin per unit equal $44. So we reduce contribution margin by $1. So dividend high. Hey, we gave up $7 contribution margin per unit and earn no profit. Here's in case of excess capacity. Both dividend, this is great. We now earn $6 more per unit. Overall, at total, the company is worth of $10,000. But the company, what happened? We were earnings $45 per unit, and now is only $44. Doesn't reflect the divisions through profitability nor provide adequate incentive for the division to control costs. Considerate for cost-based transfer prices doesn't reflect the division through profitability nor provide adequate incentive for division to control costs. Negotiated transfer prices based on existing market prices of competing goods often considered best approach because it is objective and generally provides the proper economic incentives. It is indifferent between selling internally and externally if can charge pay market price. Charge or pay market price. Negotiated transfer price, it is indifferent between selling internally and externally if can charge or pay market price, can lead to bad decision if have excess capacity. In the situation we has excess capacity may take the division's bad decision. Why no opportunity cost where there is not well-defined market price, companies can use cost-based systems. The plastic division of Western company manufactures plastic models and then sells them for $70 per unit. Its variable cost is $30 per unit and its fixed cost per unit is $10. Management would like the plastic division to transfer 10,000 of these molds to another division within the companies at the price of 40. He sells these products outside 70. Now the company wants to sell this product to other division at the price 40. The plastic division is operating at a full capacity. What is the minimum transfer price that the plastic division should accept? Because the plastic division operates at full capacity, the minimum transfer price will be the variable cost plus operating cost operating cost so it will be the minimum that division should accept 70 because the operates in full activity.